Many of you must have heard of the term dividends. For example, Reliance paid 7 rupees per share. Bajaj Auto paid 140 rupees per share. Let's quickly understand the word dividend. Let's say there is a company A. There are 100 shareholders in the company, meaning 100 people have invested in this company. You are also one of the shareholders. Say you hold 2 shares. The company earns 50,000 rupees this year, say for example. The company's board of directors decide to distribute a part of this earning of 50,000 rupees to the shareholders. They decide to distribute 1000 rupees totally as dividends. That is only a part of its total earnings. They decide that a dividend of 10 rupees per each share should be given. Since you are holding 2 shares, as a shareholder you will get 10 rupees for each share. That is a total of 20 rupees, right? Essentially, you are getting 20 rupees as dividend from the company. Usually, when the company announces dividends, the share prices rise. Now let's understand why companies give dividends. Dividends are given to the shareholders to reward them for their trust in the company. Dividends generally leave a positive impression on the shareholders as to how the company is doing. If a company is consistently giving good dividends to its shareholders, naturally they believe that the company is doing well. On the contrary, if the company having a good dividend track record stops paying dividends, the shareholders smell something fishy. That's a terrible signal to the investors that the company's performance is taking a toll, isn't it? Let's take a classic case. Take a look at the graph here. See how the stock price of GE has come down. GE stock plunged from around $30 at the beginning of 2017 to a multi-decade low below $7 in late 2018. Do you know the reason? Because of few cash flow issues, GE cut its dividends in half in 2017 and by another 92% in 2018. Such is the sentiment of dividends on the common investors. Though many experts suggested that the investors should not worry about the lost dividends because this measure is a part of the company's debt repayment and fixing balance sheet efforts. The experts also suggested that in the long run, capital appreciation is more important than dividends. Yet the stock price plummeted. Of course, there are various other reasons for the loss of hope on GE. Later, by 2019, GE got out of the crisis by clearing its debt. But overall, what I mean to say is dividends not only provide a source of income to the investors, but also instill a sense of confidence in the investors on the performance of the company. So far, so good. Let's come back to our sample scenario. There is a company B which has 100 shareholders. You are also one of the shareholders. You own 2 shares of the company. The company earns 50,000 rupees this year. The company's board of directors, unlike in the first case where they distributed 1000 rupees as dividends, instead wanted to reinvest this money in their business for buying a plant as part of their business expansion plan. Over time, the company expands its reach, flourishes in its business, and the intrinsic value of the stock rises over a period. How cool is that? Now the question here is, what matters, the dividends or the value appreciation? Let's take few examples. Berkshire Hathaway is an important diversified holding company led by the renowned investor Warren Buffett. This company invests in the insurance, private equity, real estate, food, apparel, and utility sectors. Despite being a large and mature company, Berkshire doesn't pay dividends to its investors. The company instead chooses to reinvest its retained earnings into new projects and acquisitions. Warren Buffett believes that investing back into the business over a long term provides great value addition to the shareholders instead of paying them directly in the form of dividends. Despite having good cash on hand, Berkshire almost never paid dividends to its investors except in 1967, about which Buffett jokes that he must have been in the bathroom when the decision was made. More than dividend payouts, Mr. Buffett has three priorities, that is, making new acquisitions, reinvesting in business, and buying back stocks. By doing so, he says the company's value is appreciated and hence the shareholders' wealth is also on the rise. As he estimated, the company did very well. Just look at the stock price. The company managed to deliver 17.41% since it went public in 1990. Let's see how the company performed in comparison with the standard S&P 500 index. For those of you who don't know what S&P 500 index is, it is the index in USA, just like we have Nifty and Sensex in India. S&P 500 represents the top 500 companies in America. So let's compare how the company Berkshire performed in comparison with the market, the overall market performance. The company did 27 acquisitions in 2013, each worth $1 billion to $2 billion. I'm not saying that its success is only attributed to its policy of not paying dividends and holding back the money, but it is because they are assuring the investors that every dollar that would have been given to them as dividend is being reinvested and made worth more than that dollar by generating greater value to the investor. The moment they run out of using that dollar wisely and compounding on it, it should probably make sense for them to pay it out to the investor as dividend instead of holding it for reinvestment. Whatever the company's policy is, it should be clearly mentioned in the letter to the shareholders. Let's take another classic example of a company which has a good dividend track record of 100 years, and that is Coca-Cola. Let's look at its performance compared to S&P. Coca-Cola underperformed the market index. I'm not saying that the underperformance is only because of its dividend history. The reasons could be many, but what I'm saying is that the case of Coca-Cola paying more than 90% of its earnings towards its dividends is a riskier thing for future. I don't find it reliable. The fact that the company's earnings have not grown much but dividends have been distributed a lot clearly shows that the company is not investing in its business, and this could affect the company's intrinsic value and the dividend payout in future. Though Coca-Cola is a good stock to invest in, I would not like to buy it for the purpose of dividends. Because I fear the dividend payouts in future because of the reasons I discussed above could be affected. Some people say that high dividend yields act like cushion and absorb the downside effects of any market corrections. This is not a favorable reason because why should you depend on dividends to alleviate the effects of a non-performing company? Why should you choose such a company which is subject to a worst crash during correction? So, instead of relying on dividends to offset any losses from a decline in stock price, focus on a fundamentally strong company which is bound to recover fairly during any market crash or correction. You need to focus on the business model, the company's management before opting for a stock and not rely on dividends. When a company has better things to do with retained earnings like a business expansion, clearing of debt, or investing in a great idea and thereby increasing the intrinsic value of the company, why should the company offer dividends as a means of pampering its shareholders? It's like this: you don't buy expensive gifts to your child or arrange those bashful birthday parties that he can be proud of. He might hold a sense of resentment towards you, but that's okay. You have built a small portfolio of index funds on his name right from the time he was little. His investment keeps compounding, and you give this to him at 20 years. How beautiful is that? Well, it's definitely not for everyone though. There are companies which will grow and manage dividend expectations well into the future. But that's very difficult and we have to search a lot for such companies. We need to be careful in selecting such companies. In order to select a good dividend stock, we need to select companies which are fundamentally strong and have a good dividend record in the past. And that's a tough thing. I know you can come up with the names of such companies, but my point here is that if at all such companies gave you good dividends consistently in the past, that means they are fundamentally great companies also, and you would have generated even more wealth if those companies, instead of giving dividends to you, reinvested those monies into their own businesses and helped you by the effect of compounding. Hence, you are not usually benefited by the fact that the company is paying you good dividends only, but by the fact that the company is fundamentally strong. Hence, it is disappointing to see people even plan their retirement income based on such dividend stocks only, instead of reinvesting those dividends for a better compounding effect, or choosing companies which may not offer dividends but are very strong. Talking of our Indian scenario, there are many PSU companies which pay dividends, but dividends are not always sweet, and hence beware. The truth is that government often regulates that the PSUs should distribute the dividends because the government needs money. Moreover, it is a means of holding on to the investors' money and nothing more. Despite having weak balance sheets, these PSUs have no other option but to distribute dividends, which will further weaken their systems in future. I personally don't feel dividend is a yardstick to the success and strength of the company. Warren Buffett himself, who enjoyed and is still enjoying the dividends from his investment in Coca-Cola, says that the situation would have been much favorable if Coca-Cola, instead of distributing the dividends, reinvested the same in its packaging plants, etc., to generate more value. Well, the case against dividends dates back to a paper in 1963 from the Nobel laureate Merton Miller, where he algebraically proved that as long as a company generates returns expected by the market, it doesn't matter if dividends are paid out or not. The shareholder can see the stock price appreciating and hence he can make his own dividend by selling the stock when cash is needed. There are many more such arguments, one of which can be found in the book Common Stocks and Uncommon Profits by a renowned investor, Mr. Philip Fisher.